What is going on, everyone? Welcome back to another YouTube video. In this video, I'm going to take you through a very detailed lesson on how to read candlesticks in the market. We're going to go through how to determine the strength, momentum, and who's gaining control, the bulls or the bears. Knowing this information is going to help us make better trading decisions, and our overall analysis is going to be more on point and in tune with the market, so we know where the market is going, what it is doing, and where we can make predictions to make better and higher probability trading decisions in our trading. We're going to go through a very detailed course. I've made heaps of cool fancy infographics that we can go through, and then at the end we're going to go through the live market, real data. I'm not going to fluff it up, and we're going to do some overall analysis using the knowledge I'm about to teach you. So for those of you who haven't subscribed to my channel, please subscribe. It helps share this information and helps the YouTube algorithm get this to other beginner traders and struggling traders out there. Smash the thumbs up button, and if you haven't already, please hit the bell icon so you get notified for any more courses I put up, any more guides I put up, so you can learn and we can help other traders become profitable. For those of you who don't know me, my name is Jerome. I'm a full-time trader based here in Sydney, Australia, and I'm also working alongside Austin Silver as an ASFX coach. So why is it important to understand candlesticks within the market and how to read them? Well, they help us understand what's happening in the market and help us react to what may happen next to make better trading decisions, and it helps with our overall analysis. You must think of candlesticks as a battle of power. Who is gaining control? The bears, which are the sellers, or the bulls, which are the buyers? Once we can understand this information, we can make some really solid trading decisions that keep us on the right side of the market. Just a quick disclaimer, we never know what's going to happen in the market next, so we could be reading these candlesticks, grabbing all the information that we can, and it could do the complete opposite of what the market is telling us it may do. So that's why we must stack multiple confluences, multiple signals to get the overall picture of what's happening inside the market. So without me rambling on too much, let's get into it. What you can see on my screen right now is a bearish candle. We're going to go through multiple examples, but for now, we're going to talk about the very basics of the anatomy of exactly what a bearish and bullish candle is, a Japanese candlestick. So as you can see here, we have the open of the candle, which is the top here, and we have the close of the candle, which is the bottom. These little wicks to the upside, this is the highest point and the lowest point. So that is a bearish candle. A bearish candle will open at the close of the previous candle, and it will close lower than the previous candle, making it bearish. So it will close lower than the previous candle close. We'll go through more examples on this in a minute. This is a bullish candle. So as you can see, the exact same, just inverse. This is going up. Bullish buyers are interested. So as you can see here, wicks to the upside, wicks to the downside. You have the open and the close at the top. So the open is at the bottom. A bullish candle will open at the close of the previous candle, and it will close higher than the previous candle's open. Previous candle's close, sorry. So we'll get into more examples of this right now. So as you can see, the Japanese candlestick. So we're just going to go through a quick overview of what these actually are. A bullish candlestick, which is default, they are green when they go up, red when they go down. So a bullish candlestick is increasing. It's bullish. It means buyers are interested in the price in the market. Price is going up. It's bullish. So as you can see, you have your high, which is the highest point price has come to during the open of that candle session. And you have the low, which is down here, of the wick, which is the lowest point price has come to during the open of the candle session. You have the candle open, and you have where it closed. So where price made a decision to close at. And then you have the body of the candle. The inverse for a bearish candle. A bearish candle is decreasing. It's going down. It is bearish, and sellers are interested at this level. Price is going down. It is bearish, red. So as you can see here, the high, which is the wick, that is the highest point price came to during the session of that candle. And then you have the low, which is the lowest point of the wick, which is the lowest point price came to during the session of that candle. Then you have the open, and then you have the close, and then you have the body. So price opened up here, and at the end of the candle session, it closed down here, and you have your wicks. So let's go into more examples of how we can interpret this. So as we just talked about these examples over here, I put together this demonstration. So a bullish candle, you can see bullish candle, bullish, bullish, and then you have a bearish one. So if a bullish candle, it opens at the close and closes higher than the previous candle's close. So going back to this example, it opens higher than the previous candle close. Stay with me. I have more examples that hopefully will get the message through and make it simpler and more kind of objective for you guys to understand. Bearish candle, and this one's bearish because it closed lower than the previous candle's close. So you can see the bullish candle here, it closed up here. This bearish candle closed down here. This candle is bearish because it opened at the close of the previous candle and closed lower than the previous candle's close. So at the bottom here, I have bullish green candle. It's bullish because it closed higher than the previous candle's close. Bearish, which is the red candles, it's bearish because it closed lower than the previous candle's close. Bearish candle closes below the previous candle's close. Bullish candle closes above the previous candle close, making it bullish. Just to recap, this is a very easy, basic, and simple concept to remember. If the candle is green and closes above the previous candle's close, it's bullish. Buying pressure, market participants placing buy orders. So buyers are interested at the level price is trading at. If the candle is red and closes below the previous candle's close, it's bearish. Selling pressure, market participants are placing sell orders because sellers are interested in selling at that price level. Now, let's talk about time frames. I get a lot of questions about what time frame do I trade? What's the best time frame to trade on? And we're about to get into that right now. How do different time frames affect the candles? The concept and everything we talk about going forward applies to all time frames. So we can apply this knowledge and value to all the time frames, and it's more or less done the exact same way. So when looking at the daily chart, you are viewing 24 hours worth of price action in one candle, 24 hours of trading that has taken place via the market participants. The same applies when looking at the 4-hour chart. Each candle that prints is 4 hours worth of price action. So when you are selecting your time frame in the market, you are viewing that time frame, all the price action and trading that has taken place in that candle specific chart time frame you have selected. This concept applies to all time frames. If you drop as low as to the 1 minute chart, each candle is going to represent 1 minute of price action. Essentially, it doesn't matter what time frame you choose because price will move the same across all time frames equally. So let's get into more of a deeper look into time frames. As you can see here, the daily candle, 24 hours worth of price action. So when you go into your charts and you select the daily time frame, you'll see 24 hours worth of price action in one candle. Now, if you drop down to the 4-hour chart, each candle represents, so each one of these candles here represents 4 hours of price action inside the daily bar. So these 6 candles, are inside this 24-hour candle. And the way you get that is 24 hours divided by 4 hours equals 6 candles. So essentially you are dropping down from the daily chart to the 4-hour chart and you are getting more detail. You are bringing in what's happening, different areas of value, different areas of support and resistance. So coming down to the 1-hour chart, which is over here on the right here, each candle represents 1 hour of price action inside this daily candle. So to get that, it's 24 hours divided by 1 hour equals 24 candles. And as you can see, there's 24 candles here. So essentially what we are doing, dropping down time frames, you are basically getting a bigger picture of what's happening inside this daily bar, which gives you more information. And we'll get to this in a minute, but basically the purpose of dropping down to a lower time frame is to get tighter entries, tighter stops, and find out areas of value. And then you can see the 15-minute candles. Each candle represents 15 minutes of price action inside this daily bar. So once again, 24 hours divided by 15 minutes equals 96 candles. All these candles are just breaking down into this daily bar. So we are just dropping down time frames. and we're getting a bigger picture. We're getting more information so we know where we can enter, if we can get a tighter stop loss, get tighter entries, and make better trading decisions. All right, how do different time frames affect the candles? I got over here, so note, candles on higher time frames such as the 4-hour, daily, and weekly have more significance because there is more price data in one candle. You are getting the bigger picture of what's happening throughout the trading day. The concept of reading them applies on every time frame. So what time frame should I use or look at? That's the biggest question I always get. People always ask me. When looking at a price chart, you can select a time frame such as the 1 minute, 15 minute, 1 hour, 4 hour, or the daily, and so on, even up to the weekly and monthly. The time frame you select is completely personal choice and up to the trader to decide. There is no best time frame. It comes down to what you can consistently check when you are trading. So this is a message I really want to get through to you guys. Doesn't matter what time frame you trade on. You can be successful on multiple trading time frames, but you have to select the time frame that suits you as a trader, suits your lifestyle, suits your personality. If you work full time, then checking the 15-minute chart may not work because you have other commitments, and you will not be able to dedicate the time and effort to check the candles every 15 minutes. So maybe you should focus on the 4-hour and the daily charts. That way you will only need to check the charts every 4 hours and once every day instead of every 15 minutes. So if you are on the daily time frame, you have to wait 24 hours for that candle to finish printing before you can make your trading decision. Whereas if you're on the 15-minute chart, you have to just check the charts every 15 minutes because the candles will finish printing every 15 minutes. So you have to constantly monitor it and constantly make your trading decision around what's happening on the lower time frame. So conclusion, quick recap. So you must select a time frame that you can consistently manage. If you have other commitments and can't watch the 15-minute chart without being distracted, then it will be a struggle. Choose a time frame that allows you to be consistent. If you only have 1 hour a day to check the charts, then I would suggest using the daily time frame. If you have 2 or more hours a day to check the charts, then maybe you'll be able to check the 4-hour chart. There is an exception to this. If you are a day trader, I'm personally a day trader, I trade the lower time frames, and you can set aside multiple hours in a row, then you can trade a lower time frame such as the 15-minute. So that's what I personally do. I trade the 15-minute chart, but I have a time in my day where I can consistently apply my time and effort to the chart for a few hours in a row. So with the system I trade, we stack multiple parameters and confluence signals. This way we can avoid the less probability trades setups and focus on higher probability trades, resulting in more overall winning trades and less losing trades. Trading a higher time frame will result in less trading opportunities, but it removes a lot of the noise, so the signals will be more precise, but you may go a few days, weeks without taking trades. Once again, it all comes down to balance and your lifestyle and your beliefs and how you want to trade. There is no best strategy. There is no best time frame to trade on. So the message I'm trying to get across here, pick a time frame you can consistently choose. If you choose the daily time frame, you must remember you'll have less opportunities and you'll go a few days, weeks without taking trades. But if you're on the lower time frame, you'll be taking a lot more trades, but you also got to remember you got to be more selective and it requires a little more discipline. Now let's get on to back on the candlesticks and the strength. So how do we determine the strength of a candlestick and why is this important? So the example below are the same movement in pips, which is points in percentage. It's a way we measure movement in the market. So each candle here represents 45 pips of movement in the market. Both of these candles have a lot of strength. So let's go through these examples and let me explain why. This is the candle on the left, this big red bar over here. This is a strong bearish candles. So sellers are interested in selling and they have pushed the price down. What makes it strong is that it has a small wick to the upside and a small wick to the downside. So these little things up here are called the wicks or shadows. Once again, I'm referring to wicks. This represents buyers trying to push price up. Buyers trying, and look what sellers did. They gained control, they gained power, pushing price all the way down. You can see sellers tried and buyers tried to push up, but the candle closed down here. So candle opened and it closed down here, resulting in a very strong bearish seller bar. So this tells us there was a lot of buying pressure to push the price push the market up, but there was a lot of selling pressure to push the market down and end with a strong close. The example on the right, which is this little green body up here with this massive wick to the downside, this is a strong bullish candle. Even though the bar isn't completely covered and from the open to close, when we look at this bar over here, what makes it strong is that the sellers tried to push down but failed, and buyers took control, pushing price back up and closing bullish. So you can see this massive wick over here. So think of it this way. We had selling pressure. Lots of sellers, lots of bears were trying to push this price down, and they succeeded. But look what happened. Buyers came back in, buyers took control and pushed price right back up, and it closed above where sellers tried to push down. So this tells us there was a lot of selling pressure, but the buyers are still stronger, resulting in them pushing price up and taking out all of this. So here we have some examples of candlestick strength. So just a quick note, it's not the size of the candle that makes it strong, it's how it closed. If a bullish candle closes at the very top, there was a lot of buying strength and sellers could not pull price back down. If a bullish candle closes at the very bottom, there was still a lot of buying pressure, but there was more sellers, and the sellers pushed price back down, taking control. Examples of bullish candle strength. So the examples on the left are strong bullish candles. Pay attention to the wicks. Sellers trying to push price down, buyers are stronger and push price back up, resulting in bullish strength, buying pressure. So the bulls are in control. So you can see on this one, this was the exact same example over here with this massive wick down to the downside. We can see over here kind of similar examples where we have big wick to the downside, but a body closing in the upper half of the candle. And you can see these examples where, remember, with a bullish candle, it opens at the bottom. So it opens here and closes at the top, resulting in a bullish candle. Buyers won that candle session. Buyers are in control. And then if you look at the examples on the right, examples of bullish candle weakness. So they are still bullish candles because they are closing above the previous candle's close, resulting in a bullish candle. Pay attention to the wicks once again. Buyers trying to push price up. So buyers are in control, but sellers are stronger and pushing price down, resulting in some type of selling pressure where sellers are interested in this price level and there's a real competition for the buyers. So this will help in our trading decisions. We'll get to some of the live examples in a minute. So you can see, look at these big wicks to the upside. Buyers putting in a lot of orders, a lot of buying pressure, but sellers pushing down. Same result over here. Long big wick to the upside, sellers pushing price back down. Wicks to the upside, sellers pushing it down. So there's lots and lots of selling pressure. So there's a big fight happening in the market where sellers are really trying to take control. So something really important to pay attention to. Here we have some bearish examples. Once again, not the size of the candle that makes it strong, it is where it closed. If a bearish candle closes at the very top, there was a lot of buying strength and sellers could not pull price back down. If a bearish candle closes at the very bottom, there was still a lot of buying pressure, but there was more sellers and the sellers pushed price back down, resulting in more selling strength. So examples of strong bearish candle strength. So sellers are really in control in this scenario. Once again, pay attention to the wicks. Buyers trying to push price up, sellers are stronger and push price down. Sellers are in control. Look at the wicks to the upside. Buyers are trying to push price up. Buyers are trying to take control, but sellers keep winning the battle. Sellers keep defeating the buyers, pushing price down, pushing price down. So once again, that results and tells us sellers, bears are in control of the market. Examples of bearish candle weakness. Still a bearish candle because it is closing below the previous candle's close. So resulting in bearish candle. Once again, pay attention to the wicks. Buyers trying to push price down. So lots of selling pressure, sorry. So you got selling pressure here, selling pressure, selling pressure, selling pressure. There's a spelling mistake in there, sorry. It's sellers trying to push price down. So this is what makes these candles weak, because sellers are trying to push their price down, but buyers are stepping in. The bulls are stepping in and pushing price back up, resulting in these long wicks. So there's a lot of buying pressure. So we can use this in our analysis to make better trading decisions. So obviously when you see these big wicks to the downside, sellers may be losing control because they can't close low. They can't close down here because buyers are coming in, pushing price up, keep pushing price up. So they're getting defeated. Now let's look at some examples of neutral candles. So we know we have bullish candles where we have kind of big bodies, big wicks, and all that in between. Let's look at some neutral candles. So something to note, it's always good to note the color of the candle. It is not useless, but it's not as important as where it's closing. Paying close attention to the wicks and how the candle closes can give us a great insight into who is gaining control, the bears, sellers, or the bulls, the buyers. Let's take a quick look at neutral candles, also known as indecision. So neither the buyers or sellers are in control. It's just trading sideways. Looking at the open and close of the candle and the wicks, you can see neither buyers or sellers could gain control, resulting in eagle wicks to the upside and downside, resulting in indecision. So you can see buyers pushing up, sellers pushing down, close in the middle. Buyers pushing up, sellers pushing down, close in the middle. It's a very similar theme, and these candles are very easy to spot in areas of support, resistance, or supply and demand, and we'll look at some examples of that later. So neutral candles is a decision point in the market where the market is taking a breather and it's waiting to know what's going to happen next and make its decision. Let's move on to candlestick momentum. As we discussed before about candlestick strength, candle strength is how the candle played out, the high, low, which are the wicks, and most importantly, how the candle closed. That's going to determine and result in the strength of the candle. Momentum refers to the size of the candle from open to close. Momentum candles come from significant areas of support or resistance, significant levels in the market, supply and demand, where sellers are really interested and buyers are really interested at this level. So large bodies, small wicks, and a strong close. You can see massive candles, and we'll go through some examples once again in the market to show you examples of where these candles can come from. Like I was saying, support, resistance, supply and demand zones where there are lots of orders. When you see candle formations like this, multiple large bodies, this is momentum. Lots of sell orders coming in, causing price to rapidly fall. This is due to a significant level, supply and demand, or news events. Same inverse for a bullish momentum trend. Multiple large bodies, this is momentum. Lots of buy orders coming in, causing price to rapidly climb. This is due to significant level, supply and demand, or news events. Recap, conclusion, momentum candles are usually a result from the following. Price is at a strong support or resistance level, like we just talked about before. Price is at a level where there are lots of pending orders. Orders that are triggered when price reaches a certain price in the market. So we can have pending orders in the market. Usually big institutions or banks or hedge funds will have a level in the market they are very interested in. When price comes down to that level or comes up to that level, those orders will be triggered, and then you'll see price make a very big move in either direction. So just a quick note, momentum is not created by the size of the trade. So if you put a $1 million order on a trade, it's not going to move the market. It doesn't work that way. It's from the amount of orders coming in at the same time, pressure. So knowing this tells us that the level price was at when the momentum kicked in is significant, and when we can use that to advantage when making our trading decisions. Think of it as a new shop opening, for example, and it's popular and it's advertised and everyone comes to it at once. That is what momentum is. It's an increase in order flow, not so much the amount, the dollar figure being transacted, it's the amount of orders that will create. So when you see momentum, you know a lot of people are interested in this one area in the market. To identify momentum candles, we look for the size of the candle and the wicks. Small wicks and big bodies represent strong momentum and strength. It helps show buying or selling interest at a specific level, and will also help show if price will break out of a zone or a channel. Overview and live examples. So now we know how to identify bullish and bearish candles, strength and momentum. Let's talk about what makes it bullish or bearish and how we can take advantage of the knowledge we now have to make better trading decisions. as we know, a bullish candle means price is increasing, going up, and a bearish candle means price is decreasing, going down. So bullish buyers are interested, bearish sellers are interested. The best and easiest way to translate this is very simple. If price is bullish, that means market participants are interested in buying at that level price. It's a great price to buy. If price is bearish, that means market participants are interested in selling at the level price. All price, it's great price to sell. Now, market participants are like banks, hedge funds, big institutions, retail traders, pretty much everyone that trades in the financial market, the Forex market. They're interested in at this level, and when I refer to market participants, that's who I'm referring to. With all that knowledge we now have, let's put it into practice in the live market. All right, so let's dive into a chart and let's see how we can apply all that knowledge we have just learned into the live market to help us make better trading decisions and find out what's happening inside the market. Who has more control? The bulls, which are the buyers, or the bears, which are the sellers? And let's apply all that knowledge, like I was saying before, with momentum, strength, and indecision candles, weak, strong, bullish, bearish. Let's put all that into a price chart and let's make some cool trading decisions. So I'm going to focus on GBP JPY, the most recent data. This candle is currently printing. Today's the 10th of February 2021, and let's see what we can do. So I'm looking at, like I was saying before, GBP JPY on the 4-hour chart. And as we can see, the first bar that kind of sticks out to me is this bar over here. Just bear with me. All right, so this bar over here, this big green bullish buying pressure in the market. What this signifies to me and what this tells me is that this level down here is significant. A lot of buyers were interested. As you can see, this one bar right here took out 4, 8, 12, took out pretty much 2 days, almost 3 days worth of trading in one 4-hour bar. So what does this tell me is that this level was significant. All right. So looking at this level, taking this into account, and what this tells me is that buyers are now in control. Buyers are very interested at this level, and going forward, how can we make trading decisions around that knowledge, that information we now have? So I'm going to be adding in my own confluences. So like I said in the beginning of the video, with a quick disclaimer, we never know what's going to happen in the market. We don't know what's going to happen next. A candle could be telling us a complete story, and we can gauge that from what we know. And it can do the complete opposite. So that's why we have to stack multiple confluences, multiple signals to kind of gauge the bigger picture of what's happening inside the market. So if you look down here, psychological numbers, I'm big on psychological numbers in the market because the market responds to them very well. So a psychological number is an even handle number. It's an even number. So flat handle. It's not like a random number like, 143.784, 143.417. It's like 142.900, 1.2.100, 1.2.950. It is even numbers. And if they even handle where it's 900, 800, 700, 140, the market responds to that very well. So without getting off too topic, sorry, I won't go into that too much. You can see that the market came down to 142.900, and we had this massive momentum candle, lots of buying pressure. Once again, someone didn't put like a $1 million order on to do this. It was multiple orders coming in at once that caused that to happen. Multiple orders, pending orders, whatever it was, caused this massive momentum shift. From there, we can see an indecision candle. So we talked about indecision, where even wicks to the upside, even wicks to the downside, a close in the middle, resulting in indecision. The market doesn't know where to go. So what does that tell us? We have to sit and wait, or we can use that stacked with other confluences as an indicator that price may go up or down. In this case, would you be fighting this bullish pressure, this buying pressure? I wouldn't. You can see looking left, we broke above this candle. So that is a new high, resulting in a lot more bullish pressure. So this neutral candle over here, this indecision candle, this little red one over here, would be a trading indicator or an indicator to other traders that they can place a buy order because they want to ride that trend up. So as you can see, what's happened is we had a strong bullish bar resulted by indecision, 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 and another strong bearish bar, bullish bar, sorry. So this would be momentum. As you can see, price has hit a ceiling, so we call that resistance. When price comes up and can't go any higher with multiple rejections to a level, so you can see rejection, 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 rejection. It's rejecting a level. It's hitting a ceiling and can't penetrate. So what does that tell me? Well, once again, psychological level in the market, 144.900. You can see down here, 142.900, 144.900. Psychological level in the market. I'm not fluffing this up. I just pulled this chart up for you guys. This is live. I'm just showing you how I do my analysis, how we can use candlesticks to kind of, and other confluences, other signals in the market to make trading decisions. Once again, where price came down to, let's go through these candles over here. So as I was saying, resistance, hitting a ceiling, price can't penetrate or go above this level. So it's showing multiple rejections. The sellers are protecting this level. Buyers are trying to push up, sellers are coming down, pushing it. Wicks to the upside, wicks to the upside, wicks to the upside, wicks to the upside. A buyer's trying to push up, sellers keep rejecting. Look what happens over here. We get this bearish bar and then followed through a strong bearish bar pushing price back down. Look over here, this wick on this candle here. Let me zoom in for you guys. Look at this wick to the upside. It closed bullish. It closed above this candle's, the previous candle's close. It closed above it, which makes it bullish, but it's a weak bullish candle because look at this wick to the upside. Buyers tried to push price back up. Sellers rejected it. Sellers were stronger. Bears were stronger, pushing price back down. Look at the candle next to it. Sellers trying to push down. Buyers slowly trying to take control. Buyers taking control. Indecision. Even wicks to the upside, even wicks to the downside. Let me just get rid of my, all right, there we go. Even wicks to the upside, even wicks to the downside. This indecision, indecision. This candle over here, sellers trying to push down. So sellers strength has now entered the market. We are trying to push down. You can see this wick is lower than this wick, and it's lower than this candle's close. You see how that candle closed lower? I hope you guys can see this all right. Then that close. What does that tell me? Sellers are slowly gaining control. We are gaining control again. The bears are gaining control, and we may see a follow through on the next candle. What do we see? Massive momentum. Look at that. Bears took control of the market, pushing price down. Now, once again, extra signals in the market. We have a level, an even handle level down here at 144 flat. This is a very strong level in the market. Looking left, you can see we rejected that level over here. See sellers, buyers trying to push up. Failed, rejected. Then you can see this massive momentum candle that we first talked about broke above that level, right? 14400, and then we had that momentum shift to the upside. So adding these confluences and signals into the market can really help you make better trading decisions. Going forward, you can see what is the market doing. So now how do we use that information and predict what may happen next? Well, I can tell you now by looking at this. Obviously, there is some type of selling pressure. Let me just get rid of these. Between here and here would be a zone. There is selling pressure. Sellers are interested in this level. But how do you know price may not go up? Well, this is the great question. If everyone knew, a lot of people would be very rich. So let's try and figure out how we can use this knowledge to predict what may happen next. Now, because there is selling pressure in here, doesn't mean price is going to keep falling. We can see this momentum shift from up here. What has happened? We've had simply a pullback to this level, right? This level over here I was talking about, where price broke above. That 144 even handle number. To me, buyers are still in control. If you want to know who is in control, buyers are. Because look at how much coverage they have gained. They've pushed price from all the way up here, and sellers have only moved price from here to here. And if you ask me, from what's happening recently with this buying momentum, back from this level, buyers are picking up momentum, gaining control. So my predictions using this knowledge and looking back at historic data and what's happened in the past, I would expect a move higher. Now, I'm not going to go into too much detail on predicting, generating targets, profit targets, where to put your stop loss. I'm just talking about how to read these candles and do simple analysis to where price may go using simple supply and demand zones, support and resistance, and simple price action trading. Now, I'm a trader that uses indicators, and I'll quickly bring up the indicators I use. So I use the 8 exponential moving average. Now, a moving average is simply gathering price action, price data, and smoothing it out, making it dynamic support and resistance. So instead of fixed levels, such as these zones here, these red lines, it's dynamic. So it moves with the market. I have the 8 exponential moving average, the 21 EMA, which is the exponential moving average, the 50, the 200, and the 800 EMA. You can see this red line. Let me just make that a bit thicker for you guys. This is like a total bonus in what I'm trying to teach over here. Let me get rid of these. Actually, I'll get rid of this top one here. You can see that red line is in that zone of support. You can see price has tried to break below that red line, and it failed, and price is now back above it, resulting in an uptrend, bullish strength. Buyers are in control. Sellers can't take back that level. So using that information, using multiple signals, multiple confluences, I can predict that price may come higher. So I hope you guys got some value out of this video. Majority of it, this was kind of a little bit of a bonus at the end of these live examples, but I hope you guys got some value. If you did, please smash the thumbs up button. If you're not already, please subscribe to my channel to help the YouTube algorithm get this knowledge and value out to other struggling traders or traders that just want to improve on their price action trading. And if you haven't already, please smash that bell icon as well so you get notified when I release new content, new guides, new courses like this. I'm actually in the process of putting together a completely free beginner's guide. I'll be uploading it on YouTube. It's going to be about 5 parts, and I'll be doing stuff like this, but I'll be covering a lot more detail on how to read the markets, how to use indicators, how to make predictions, stop loss targets, trends. It will be really, really jam-packed with a lot of value and knowledge. So I'll have a link in the description. Go check that out, sign up, register your interest, and I'll keep you guys updated when it's going to be released. I'm hoping it will be released in the next 2 to 3 months, but I'm putting a lot of effort since I'm not really much of a perfectionist, but I want to be able to kind of give you guys how, the best knowledge and the best way to succeed in trading. As we know, trading isn't very easy. It is a very hard skill to master, but my goal is to try and help struggling traders and help you guys become profitable. So once again, I appreciate your time. Let me know in the comments below if how I did explaining it. If you are confused, please let me know. Give me constructive criticism. Let me know how I did, since this is kind of like a trial run for my course that I'm doing for the YouTube. So once again, I appreciate your time. Thank you so much, and I'll see you guys in the next video.